Pre-formation decision number 2, solo or partnership. This is the one where the social pool and the operational reality diverge the most, because everybody knows another coach they admire, and the daydream of building something together is genuinely appealing. The structural reality is colder. A partnership doesn't reduce your workload, doesn't double your client list automatically, and doesn't split your stress. What it does is add a second person to every decision, share liability for what your partner does in the practice's name, and lock in a dissolution process that almost no founding partnership thinks about until it's already too late to design. Solo dominates in coaching for reasons baked into the work itself. Coaching revenue is personal service hour exchange. You sell hours, you deliver them yourself, and the multiplier you'd get from a second partner doesn't materialize the way it does in a product business or an agency. Operating decisions in a solo practice are almost always unilateral. You pick your niche, set your rate, design your offer, decide whether to take a client. A partnership turns each of those into a two-person conversation with veto rights. The reduction in unilateral speed is the cost the practice pays in exchange for whatever the partnership is supposed to add. And most coaching practices don't get enough back to justify the trade. Solo mechanics are clean, sole proprietorship or single member LLC. One Schedule C on your personal 1040. The LLC is treated as a disregarded entity at the federal tax layer, meaning the IRS looks through it to you and taxes the income on your individual return. One taxpayer, one set of books, one annual federal filing. You can elect S-corp tax treatment later when revenue justifies it, and that decision sits in Module 4. The point of the solo default isn't that you'll never grow. It's that the founding structure should be as simple as the operation, and you can add complexity when the operation actually requires it. Partnership mechanics are a different category of complexity. A general partnership, two people doing business together without any entity filing, gives both parties zero liability protection and exposes each to whatever the other does in the partnership's name. Almost never the right answer for a coaching practice. A multi-member LLC or an LLP gives you limited liability, but the federal tax treatment is partnership, Form 1065 at the entity level, plus a Schedule K-1 issued to each partner that flows to their personal return. The partnership return itself usually requires a tax preparer with partnership experience, which is a CPA fee tier above what a Schedule C return runs. 3 rationales make a coaching partnership genuinely worth the governance load. First, you're building a training school or a program business with shared certification, where the revenue and intellectual property are jointly owned rather than allocated to individual coaches. Second, you offer integrated complementary specializations that genuinely cannot be split into a referral arrangement, because the value to the client depends on both of you being in the room delivering together. Third, you already have a pre-existing relationship with tested governance, years of working together informally, and a specific new entity or program you want to formalize around. Outside those 3, the structures coming up next usually do the job more cleanly. The buyout problem is where I've watched the most coaching partnerships die, and it almost never dies from the dramatic failure modes people imagine. It dies from one partner wanting out, for a move, a health change, a different career interest, a family reason, at a different time than the other partner is ready to lose them. If the operating agreement has no written buyout provision covering valuation methodology, payment terms, and intellectual property ownership at exit, The dissolution becomes a negotiation between two people under the worst possible conditions: high stakes, depleted goodwill, and no agreed framework to anchor the math. Two structures often deliver what a coaching partnership was supposed to deliver without the partnership entity at all. Referral arrangement. Each coach keeps their own practice, own books, own tax filings, and they send each other clients when a fit is better with the other coach. Subcontract. For a specific engagement where one coach has the relationship and the other coach has a specialty piece, the first coach holds the prime contract and brings the second in as a contractor on that engagement only. Both structures are clean per engagement, both preserve each coach's tax treatment, and both avoid the buyout clause problem entirely. Most coaches asking about partnership actually want one of these. Two coaches want to launch what they're calling integrated leadership and communication coaching, and they ask whether a partnership is the right shape. Run the 3 rationale test. Training school? No. They're working with individual clients, not building a shared certification. Integrated indivisible delivery? When they look honestly, the leadership work and the communication work do divide. Clients could be coached on one without the other and still get value. Pre-existing tested governance? They've collaborated on 2 workshops, not on operating a business together. None of the 3 rationales lands. The cleaner shape is each coach forming separately, running a referral arrangement, and subcontracting when a joint proposal calls for it. If you're seriously considering a partner, write the 3-year exit scenario before you form anything. One of you wants to leave the partnership in year 3. The other one is staying. You have to value the practice, divide the client list, split the shared intellectual property, coaching frameworks, course materials, brand assets, and agree on payment terms for the buyer to pay the seller out. Is there a valuation methodology you can both name now, in advance, that would still feel fair under that future pressure? If the answer is no, the partnership is operating on the hope that nothing changes for 3 years. If yes, the rationale earns its keep and the operating agreement has its anchor. Open the solo versus partnership decision sheet and run your situation against the 3 rationales explicitly. Mark each one yes, no, or maybe with a sentence of reasoning. If any of the 3 rationales lands cleanly as a yes, the worksheet walks you through the buyout clause prompts you'll bring to your attorney before formation. If none of the 3 lands and you're still pulled toward partnership, the question to ask yourself is, what operational pressure is doing the pulling? Workload, isolation, skill gap, and whether one of the alternative structures addresses it. The decision binds for as long as the entity exists, so spending an hour on the worksheet now is cheap insurance.